think of like, Hulkster. It's awesome. The green guy. It's good stuff. What music was that? Uh, Beach in Hawaii. How did you not know that? Ziggy Marley. So half the year, I actually live in Phoenix, Scottsdale, well, Paradise Valley, the town of Paradise Valley. The other half of the year, I live in the Virgin Islands. So you got to get to love like Ziggy Marley. You live down in the islands over there. You have to know that. It's about as far away from Hawaii as you can possibly get, though, is the Virgin Islands. In fact, we live in St. Croix, which is as far east as you can go and be in a United States territory. All right, you guys ready? So as I was saying, a few informalities. First of all, I'm watching chat. People always ask, "Is this recorded?" Not recorded. Well, we're recording, but this is not a recorded session. This is as real time as it gets. You will see me periodically, bring up my screen over here, and obviously markets today. Funky, funky little market today. A little bit of a rally. We'll sell off. We've laughed. We've cried. I like it, people. You can ask questions throughout the course today. Myself and a number of individuals are in here. We're reading it in real time. If I don't get to your question during the primary session, I'll definitely be able to grab it thereafter. Without further ado, let's get officially started over here. Sorry, I'm cracking up over here. So, by the way, where is everybody joining us from? I have to ask that. It's like, again, right now, by the way, I am in Arizona. I'm in Arizona for a couple more weeks, and then I'll head back to the island. Let's get off and rolling over here. So, excellent. So, the green guy in a sea of red. Okay, this mystery guest is actually up 4% on the year. And we're going to discuss that quite extensively here in an investment portfolio. Risk disclosure. Look, many of us come from the broker dealer background. We're not financial advisors nor broker dealer. Copyright disclaimer. This is ours. This is not yours. Nevertheless, if you ever need to get a hold of me after today, or anybody here at TheoTrade, just come right over here, support at theotrade.com. Look, I feel very strongly about your capacity to be able to reach me directly. Don't think that we sit and hide out over here. Okay, it's good. So sure. From Iceland and Spain now, people, you guys get around over here. So with that, here's a just a quick again, I call it the nickel tour of me. So um, first of all, some people are not really familiar with Theo Trade or Don Kaufman, and I'll just, as I said, give you kind of the nickel tour of where a lot of this group, Theo Trade, and Theo Trade is not just myself, where a lot of this group kind of got started. Our roots actually come from very early Thinkorswim days. So again, most people have these like long stories how they got involved in the business. I grew up in this business. I had family that traded. So I had no intention of getting into this business, none. And kind of ended up into it in a backward situation where I went to Chicago on a whim. Next thing you know, you put a 22-year-old kid in a trading floor. He's there. I met some traders on the floor. Tom Sosnoff, Scott Sheridan joined Thinkorswim, was an executive there. We took the company public in 2007. It was a $600 million deal. Then there was TD Ameritrade that bought us. That was a $700 million deal. I signed a 5-year lockup clause with TD Ameritrade, and I left in 2015. And when I left TD Ameritrade in 2015, I took what at that time was like kind of the cream of the crop of our group from the original Thinkorswim days, and I took them with me, and we actually built a company called TheoTrade. And that's is where you are right now. So what you get here at TheoTrade is the knowledge of what we had back in the Thinkorswim days of watching order flow. Look, we know what works best, specifically and explicitly for retail clients. Anyway, that's the nickel tour on me. Back to the green guy. The green guy. All right. First thing, okay. This is actually a video that was shot here at TheoTrade back in November 20th, 2024. The reason I'm bringing up the date and attention to it, okay, in this particular video, you saw the tariffs coming literally in November, okay? It's a new day, however you feel about it, okay? and new days call for a different approach and a new set of stocks and even entire sectors to watch. Okay. There are clouds on the horizon, talk of tariffs, and warnings that retailers are suffering. The dominoes appear to be falling on imports and Chinese stocks. That, people, is a quote all the way back in November 20th, shortly, of course, after the elections, specifically from our green guy. Magnificent Seven performance, okay, down 28% to start the year. 35% of the market follows seven stocks. 493 stocks have limited impact on the markets. And I wanted to start with that because it's also incredibly important to understand that, by the way, speaking of this Magnificent Seven, literally today, okay, we're going to have Apple and Amazon after the bell, which of course, are two out of it in even today's performance in today's marketplace. Those two stocks is Microsoft. That is a big driver along with Meta today. That's again 35% of the market follows seven stocks. I mean, the goal over here is for you to recognize 493 other products, okay, have a limited impact on the markets, but still, okay, can have huge potential out there. One portfolio thrived. Year to date, okay, is 4.1%. Now I say that because obviously that's in the green, but the markets, the max drawdown, okay, has been as much as 23.6%. What you're actually looking at here, right, is specifically right here is the S&P, okay? This is our green guy's performance. Study inclination effectively to the upside. And people, okay, that is what you want for growth of a portfolio. Okay. Tore up the tired rules of retirement planning and investing and started with something new that no one else is talking about. And you're going to get to see kind of behind the curtain today. Again, really, really important to see. Again, this is all okay. Live trading, live execution. Again, one portfolio thrived. Deep currents. Ladies and gentlemen, I bring in now none other than Mr. Blake Young. So, Blake, are you with us? It's okay to come
I
out
am.
now. It's okay to come out. Blake
The
Young.
green guy hiding in the green room.
I'm sorry, but I absolutely love the green guy. I love it. So, you know what? I'm not the best at reading some of the bios over here, but I've known Blake. We go back over 20 years. So Blake and I actually worked together very early Thinkorswim days. Blake, okay, has been instrumental in understanding, okay, really what I would term, initially was like money flow, but now, it's so much deeper than that, and understanding currency trades and so forth. He's been a principal for a commodity trading advisor and a hedge fund manager, senior currency analyst, okay, financial market instructor for 24 years, and obviously has created a tremendous amount of educational content, both at the early Thinkorswim days and here at Theo Trade. Okay, and I do appreciate your infamous saying, "I would rather miss a good trade than take a bad trade." So, without further ado, Blake, I'm going to turn it over to you. You're welcome to kind of have at it over here,
Well,
Lady
thanks.
Blake Young.
Thank you. I appreciate the introduction and that last quote. As much as it seems a little silly to quote yourself, uh, it's important. It's more of not me quoting myself, but it's a mantra. If we're talking about our retirement funds, if we're talking about what is going to get us into those golden years or sustain us in those golden years, I really would rather miss good trades than take bad ones. My portfolio's goal and everything we do here is about not losing and growing that account steadily, consistently. And what I look very specifically for what we've deemed the X flips inside of this deep currents. So the X flips, as you can see on the chart, I'm watching four major asset classes. That's what these quads are for. I will walk you through and show you why we're looking at each one of these things and setting up for these trades. So as I'm looking at these and we're watching these moves, I'm paying attention to when we see a major shift. One of the things I tell people all the time is money is not created or destroyed. Now, obviously, if central banks are involved, money's created, but it's not destroyed. In 2008, 2009, and 2001, we know that the money left retirement accounts, left 401ks, left the equity market extremely fast. And we'll talk about that. I'm going to show you very specific ideas and clues and how this would have played out in those timeframes, how it's playing out now, what it did in 2002. We can walk through all of that. But the key is that when money left one area, it had to go somewhere else. Just because hedge funds and equity markets and retail traders were seeing red in their retirement accounts and their main portfolios, it didn't mean money wasn't going somewhere. It did, it went somewhere. And that's what we look for. We look for these X flips in conjunction with those moves. And the thing to pay attention to is we're here to outperform the market with less risk. I mean, that's it. We want to outperform the market with less risk as we're watching the market shift. We're going to build a portfolio together on day one. We execute correct asset allocation. We do not over leverage. We do not over risk. We need to know which investments are the strongest to generate a solid, consistent return while helping us avoid that exposure. We're going to identify as well the 4 biggest threats to your retirement, whether you're in retirement or approaching it, or maybe it's down the road 30 or 40 years. It still is applicable to you today. And I'm going to show you how to take control of your financial future and really get positioned for the upcoming deep current shifts. We have those going on right now. They're setting up, and we're taking a look at some pretty interesting, strong, I mean, maybe multi-year shifts that are going on right now. And one of the things we're seeing is we're seeing these currents change dramatically. As an example, we did 250% return on risk in a covered call dividend strategy. Now, a covered call dividend strategy, don't worry about that. The main thing is we're getting key signals in major asset classes. We're selecting timing and momentum in a sub area of that class. And then we'll talk about those strategies. What may be complex to some, they may sound more complex, but they're super easy to manage. And that's worth that little bit of extra management so that you can stay safe while understanding what we're doing as we go along through these trades and these ideas. We have other trades like catching the wave here. You can see we've catched the wave even with that massive drop. Now that massive drop was correlated to fixed income type trades, and we caught the trades in 2 different swings on that one. Despite the massive drop, we were able to pick up 124% return on risk. But again, the currents are shifting now. If you're positioned right, the current will get you to where you need to go. If you're not, you're going to drown. I mean, it's unfortunate, but that's the case it is. If we know how the current flows, if we know what we're doing, that'll get us to where we need to go. I will be telling you about 2 new rapidly developing currents and how I plan on riding these currents, how that's played out. And by the end of this briefing, you're going to know how the currents are moving and how this strategy will benefit you over the next few weeks, months, years, and even potentially decades. So as an example, I just said fixed income hedge. This is one of my favorite things to look at. You can see this trend is shifting. I already showed you earlier that this is part of our major asset classes in an X flip. That X flip occurs, and we see the change in those moving averages. The price action confirms, and we saw this, and this was a couple of weeks ago, that we saw it recover and bounce up. This is what we're using as that hedge, and we're seeing that move higher. And that move higher is only confirming it even more today. This was shot 2 days ago. This image was shot 2 days ago, and this is even bigger. I'll even show you that here momentarily. I'll show you that quad again. And that's not the only change, the only shift. We're seeing another shift in a $6 trillion a day industry. We've seen that rally up through here. We've seen it correct way down. I'm going to show you an updated slide here in a minute on that quad again and show you where that's going. But in the end, with these current shifts, you might think, well, but what about everything that's going on? Think about the headlines you've seen, the news items, the information that we're just plagued with. I'm going to call it a plague because it is a plague. We see the markets and institutions reacting to news, whether the news is legitimate or playing out or not. Just the rumor. It's the old idea of buy the rumor, sell the news. So people are reacting to rumors. We've seen all sorts of ideas. You know, I've got these. We have the one plague year. We've got the worst crash stemmed by banks. That's your 1930s crash. We have bailouts planned. We're talking about the 2008 too big to fail, the .com bomb or the dot bomb, and obviously tariffs right now front and center. What are you hearing? What's the market telling you? What's your financial advisor telling you? I mean, if your financial advisors reached out to you, have they talked to you? Have they actively reached out to you and talked to you about anything? Have they told you how they're managing all this? Did they manage anything at all? Because I'll tell you something right now. I've got this letter here. I, since it's kind of hard to see through here, I actually took a screenshot when I got it. I printed it out. This is an email from a friend of mine who the friend of mine has a fund, a retirement fund, and he's begged and begged and begged me to be able to manage some of my money. So I literally gave him $7,500 to manage. And I said, here you go. And I'll let you handle $7,500. You show me what you can do and we'll talk. Well, I got this email and it's kind of hard to see in there, but I want to read to you a couple of things that it says. It says, the momentum of emotions from tariffs continue to create magnified volatility, which is drowning out material economic data. Okay, I can get behind that. But here's something I want you to hear very specifically. This is the very bottom of this page. I know it goes funny with my blue screen, but at the very bottom of this page, it says, markets always recover. This will be no different. It is simply a matter of time. What does that sound like to you? What is that phrase? Let me use one more time. I think it's a fantastic reminder to me and hopefully to you as well. What change the words here and tell me the short version of the strategy that is being used here. Markets always recover. This will be no different. It is simply a matter of time. What does that sound like? Buy and hold? Does that surprise any of you? That
Am
the
I supposed
financial
to stay
advisor,
quiet at this point and say prayer? It's whenever you say that, like, it's prayer. It's a little bit of prayer in there. Okay, I'll continue.
no, you're fine. I was more going with the buy and hold idea. And the market, that's what these financial advisors do. In fact, I should tell you that when I was working for TD Ameritrade, I used to travel all across the country. And I would go into the branches and teach simple ideas, like what I just showed you earlier, this idea of a dividend strategy, covered call strategy combination. Simple ideas, what I consider super elementary and beginning foundational, but super safe while still creating income. And I can count on one hand out of dozens and dozens of branches, which would mean hundreds and hundreds of advisors that knew what I was talking about. And so the fact is they are set in this situation where it is an issue of buy and hold, buy and hold, buy and hold. That's the old model, and is what creates this uncertainty where you're watching this tweet, you might be just like this guy. You see the tweet come out, you see the new data. Well, we have tariffs. Well, we're raising the tariffs. We're pausing the tariffs. We're getting a deal. We're not getting a deal. We're not even at the negotiation table. We're about to finish on the negotiation table. We have 20 some that have agreed out of 300 different countries. You know, what are we really talking about? And when we're seeing this, it goes swinging up and down, up and down, up and down. We can get rid of that. We can get rid of that emotion. We can get rid of that spike and the crash and the spike and the crash and maintain and protect. And the reason why is because the game has changed. Think about old baseball days with Lou Gehrig and Babe Ruth and shoeless Joe Jackson, right? Compared to today, it's obviously filming is amazing, but it's changed, it's altered. The money game has changed as well. We have so many different things. We have a push button world economy. We can trade currencies across the world and change where our asset risk is. We add into that crypto. We add into all that discussion, this idea that we have nearly zero commissions and all these things. And the advisor fees didn't move. And we're seeing then versus now kind of scenario. Back then, and maybe currently for some of you, your money's tied up. Your advisor may or may not be self-serving. There's sucker fees, and you're a prisoner to the S&P pretty much. That 90% of hedge funds and retirement accounts follow the S&P. So you're a prisoner to the S&P anyway, and it's very passively managed. But if you're self-directed and can see how to use these exploits and these changes, you have full freedom. It's your interest first. We get to minimize the fees. You can profit in all types of market, and it's going to be a little more actively managed, but not so much that it changes your life. It's super easy, super consistent, and it's a matter of taking your time and being patient. Now, I do need to tell you that as far as this discussion, let's move it through here. I have a history with advisors. I was hired to work for an advisory firm. And I mean, this is a story that I've told before, so some of you probably heard it. But, and like I said, I'm going to leave the name of the group out because I don't think that's helpful, because I think this is pretty consistent across the board. In this firm, we got pulled in. And during my lunches, I'd go call my old clients. I had commercial lending clients and import clients. I did a lot of things back in the 90s and early 2000s. And they would call me and they would say, hey, what about this? Can I do this? And so I had all these clientele that are big business owners and small business owners. And that's part of the reason why I got hired. They were hoping that I'd be able to bring in all these people. I got pulled into a meeting with everybody else, and the VP, the director of our department, yelled at us and said, stop trading your clients' accounts. Put them into one of our Fidelity funds, leave them there, and get on the phone to the next person. And that didn't sit well with me. It kind of became this self-serving, lock you up, leave you as a prisoner to the S&P 500. And it didn't really matter how well that was going to benefit or hurt our clientele. I wasn't willing to let not only personal relationships or business relationships get hurt, I wasn't going to let that hurt my account, my parents' account. It's real. This is real people with real money. And within a couple of days, they got pulled me in. They had a tendency, they love to do this. Apparently, I found out after that they would pull everybody in that was new to the company, and they'd try to do a scare tactic to make sure you're loyal and going to be consistent. And they had this little tiny base salary and huge commissions on that, and pulled me into the thing. And so, and they said, and the guy, I was about to say his name, said, I walked into the room and the HR director was in one seat and he was in the other. And he puts me in the diminutive chair in front of him and he says, I couldn't sleep that last night because I was so worried about you being on phone calls and not putting the people in these funds. I just don't know how it's going to work. And apparently that was the tactic to scare people to stay with the company. And I said, you're right. It's not going to work. Where do I leave my stuff? And I left that day and I didn't look back. I would not be that kind of person that wouldn't allow the adaptive freedom and financial freedom that comes from actually understanding how these markets move. And again, it's the reason why we dealt with this. We've had a consistent, solid return week over week throughout this year. And we're just slowly climbing up and it's climbing consistently. But here's the thing, if you fall down 23 to 30%, how much does it take for you to get back to break even? Think about that for a minute. Maybe you want to run the calculation. If the market falls 30%, how much do you have to gain per year to recover that 30% versus if you consistently make 4 to 5% in that downturn and then make the majority of the growth in the upturn? How far ahead will you be? What it comes down to is this. I'm a swimmer. I actually swam in high school. I competed. I placed in region and state. I was a butterflyer. So I'm a pretty dang good swimmer. I always joke that I put the man in manatee because I'm sure I'm just a little goofy looking blob in the water, but I can swim fast. But as we're looking at this, here's the thing. Even as a strong swimmer, you can't fight the current. You just can't. The currents change, and we're talking about millions and billions of gallons of water moving down a river. You, as your little single person fighting that, you cannot win. You might think, I am such a good swimmer. I'm such a good trader. I might be able to fight the current. And we think we're the salmon in the river. And you might think you're doing really good, right? You might think you're outperforming. I can absolutely trade against the trend, the current, and the changes and the shifts because I am the best dang swimmer, best dang trader in the world, and I can do it. But what's the outcome for those salmon or steelhead? What ends up happening? They might make it to the top, but then they die. Or they might not even make it to the top. The bears will eat those little upswimming salmon. And if we're fighting the downtrend, we will be eaten up. Even if you think you can fight the current, even if you can avoid the bears, there's still hidden rocks, there's eddies, there's undercurrent, there's traditional managers, there's tweets, there's changes. And when things are taking away, damaging you as you hit a hidden rock, as you get stuck in an undercurrent, as you get slowly drained of your retirement by leeches. That's the stuff that hurts you. But if we understand which way the current is flowing, we get to go with the current. Now, we just don't just jump in and say, hey, the current's going fine. I've rafted the Salmon River, and Salmon River is an amazing place to go. It's beautiful country. Spent 5 days on the river. And absolutely, if I go with the current, I'm going to get to the bottom of that river, at least to the next spot where we get out. The question is, even then, am I going to be alive? So when we go in with the current, when we go with the current, we still get ourselves in the boat. We just don't jump in. We have helmets and life jackets and oars to help slightly tweak it, to time it better, because that's what I do. I find the current, we're going to put you in the safest possible situation that is going to avoid losses in your retirement. We're going to still put your helmet on. You have to wear a helmet, meaning you've got to have stop losses and safeties in there. We're going to have the tweaks and time it with those oars. And that's what's going to get us down safely while enjoying the ride and getting us to our destination. And we do that by buying the strongest and selling the weak. We look at those major asset classes, and then we drive deeper in that. The thing is, when we're watching those major asset classes, you've probably heard the old phrase, a rising tide lifts all boats. But the thing to remember with that, there's more to the story. The rising tide isn't just water lifting. The moon causes the tides to change. We think that we know, oh, my boat's lifting. We're looking at this little tiny thing. It's an entire sphere, a planet, as it were, a satellite that is causing the water to rise. The moon is causing that pull. So there are more things, there are bigger things that are causing these things to move. And anchors can keep us to the ocean floor. But if we have a hole in our boat, does it really matter what the tide's doing? If you have a hole in your investing strategy, if you don't understand where money is going, if you don't understand where the leak in your boat is, it doesn't matter how high that tide lifts. If your boat has a hole in it, if your trading plan, if your investment, if your portfolio has a massive hole in it, and I always think of Gilligan's Island, the hole that they always show on the beginning of at the SS Minnow. If your boat has that kind of a hole in it, it doesn't matter how much the tide rises. Your boat is staying at the bottom. And as we saw from Gilligan, you're not getting rescued. You've got to patch the hole. You've got to start with fixing that and having a tradable strategic methodology of protecting your portfolio so that you can ride those currents. And that really comes down to watching where that money moves. And that money moves in 4 major asset classes: stocks, currencies, bonds, and commodities. Now I drill down into that, into US dollars versus euros, and money markets, and cash in your trading account for currencies. Long-term bonds, we look at long-term government bonds, short-term government bonds, corporate bonds. We also use fixed income substitutes in that portfolio. Stuff that's not normally considered a fixed income, but are dividend pairs that mirror and are correlated, maybe surprisingly, to those assets as well. Commodities, we look at gold, we look at copper, agriculture prices, and oil. We pay attention to PCE. We look at stocks to determine which sectors are the best, individual ETFs and individual stocks. And we trade in and out of those with very specific strategies on momentum breakouts with longer term views following those broad currents, those great big currents. There are ways to read the deep currents or movement of money to outperform the market. And if we know what the deep currents are, if we know which strengths to buy and which ones weakness to sell, we will come out ahead. Now I'm going to show you this. If you want to get a pencil handy, again, it's recorded. You can watch it later. But if you want to get a pencil or pen ready, I'm just going to show you some of the correlations. This is in the recording and it'll be there for you later. But if you want to jot these down, I'm going to walk you through a couple of the deep current correlations that maybe we don't realize are there. So 30-year treasury yield and commodities. These have a very high or positive deep current, meaning they move together. They have a tendency to react and respond together. People generally don't think about treasuries giving you clues in commodities. That would be treasury yields, not treasury prices, but treasury yields versus commodities. Historically, over decades, that has been a positive correlation. There are times those correlations fade out, and that's actually an opportunity to plan and strategize for when they get back to their correlated behavior. That means it's going to have a negative or inverse correlation to bonds versus commodities. So this would be bond prices, and they have a tendency to go opposite. This only clarifies and validates the previous with the yields. So when commodity prices are Well, let me restate, when bond prices are rising, generally speaking, commodity prices start to fade. And that's what we're looking for as confirmation to some of these deep currents, a positive correlation, a negative correlation to those deep currents. We look at dual inflation. This is a fun one. Dual inflation or deep current. This compares commodities and commodities versus treasury price ratio. When we watch commodities versus the treasury price ratio, we get a true definition of inflation. We're taking this as a risk-free premium. I don't need you to worry about that right now, but it's a commodity versus treasury price ratio compared to commodities in general. And that can tell us really whether we're doing deflation or disinflation and inflation. And we see where we're at today. Any surprise that we are rising in inflation and have been a lot longer than we thought we would? As we look at that, are you hedging that? Are you surprised to see commodities fall like oil? We knew that was coming. We saw it coming. We saw the data tell us this is the way it is. Now, as we look at this, we're going to look at bonds and equities as negative or deep current. Now, that negative, I will tell you this. A lot of people know that. You say, hey, equities are rising, bonds are falling, or bonds are rising, equities are falling. We're generally looking at this as a hedge against risk. In the short term, is really what this comes down to. The short term, they're negatively impacted or negatively deep current, but in the long term, they're positive. And so I was looking at it as kind of like a double helix twisting around each other. The difference between those two in the short term go opposite. In the long term, very long term, they go positive. And that is also a sign of inflation. And when we see them rising together over a long period of time, it can be an indication that inflation is rising. If they're falling together over time, it shows you that we're getting disinflation or deflation. The dollar's purchasing power is a negative deep current against commodities, or an inverse correlation against commodities. The dollar's purchasing power compared to the rest of the world, if it's gaining, commodities are generally falling. And we look at that negative correlation. Now, here's a grid really quickly for you. Asset one versus asset two is positive or negative. You can see treasury yields versus commodities, positive. Bonds versus equities, negative. Commodities versus the US dollar, negative. US dollars to bonds, positive. US dollars to equities, negative. And equities to commodity are generally positive. These are the correlations that can help you clean up your trades, confirm whether you really should be taking that risk and stepping into long-term trades or investments into bonds. Or maybe it's not time for bonds. The 60-40 days that you just put 60% in bonds and 40% into equities, if you're still in that as a retiree, you need to be a little concerned. That's gone. That's dead. It's something that just doesn't work.
Those days are long, long over. Absolutely, I absolutely agree. Because that was always the mantra when we first started in this business. I know we started about the same time. It was like, and every year you got older, it was like more bonds and a little bit less like equity product in there. I cannot agree with that more because the correlation is, or the inverse correlation is completely broken down over the years. It's and there's so many advisors right now that still do that. It's shocking at this point in time.
Yeah, it's I mean, really what it means. I love John J. Murphy. John, I know Don's not as big of a technician as I am. I love John J. Murphy, but he looks at intermarket correlations as well. And he says, what this means for us, those correlations I just was showing you, what this means for us as traders and investors is it's no longer possible to study any financial market in isolation. You've got to be aware. It doesn't mean simply buy bonds because you're in retirement. It's just not safe. It's not even a matter of it's not going to produce what you want. It is unsafe. It is no longer working. So what we do though, is we look at how these have moved in correlation to each other. You cannot blindly just put asset allocation in and say, yep, I'll see you when I'm 65, or yep, now I'm 65, I'll see you when I'm 85. You can't do that. But we do look at those correlations because those correlations have been consistent all the way through. And we look at those changes in the deep current all the way through. And we look back historically and we remind my favorite quote. Why look at history at all then? Because history never repeats itself, but it does often rhyme. We are looking for those rhymes. I love this quote. Mark Twain has had some of the greatest quotes of all time. But here's the thing. We are looking for the rhyme. It's not going to be exactly the same, but we're going to see how it's going to keep us safe. So to hedge out risk, we will rotate into strong currents and out of weak ones. We're going to go back to this slide, and I'm going to pull up the current one. This is what we did a couple of days ago. And I just want you to see the difference between this and what we're dealing with literally today at this very second. We're going to throw that chart on, and so we can see the comparison between those two. And you can see what we're seeing is that the X flip, the bearishness in the equity market, has not really confirmed the reversal yet. So as much as this rally is great, and we like the fact that it's helping our 401k, we haven't got the conviction to get us through the long-term changes and flips. The dollar has been in a sell-off, and its purchasing power has been getting clobbered, and that's why gold shot through the roof. Now, today's breakdown on gold was a little bit surprising to me. I thought we might go into a holding pattern here, and I commented about that. You know, the deep currents, we've looked at some opportunities to step back into gold. So this might be an opportunity lower, but we got to let this pull back and define our timing. The current's there, but the timing isn't. And that's what we do at deep currents. As we look at this bonds, even with this massive, literally 40-year correction, biggest single weekly drop in bond prices in 40 years, 42 years, and the current wasn't broke. The current is still in the growth phase. And so we're timing that one as well. We're timing into fixed income on these. And that's what we do. We look at those currents of those asset classes. We find the specifics inside of those, the ones that are going to be the safest, the best opportunity, the best pricing, how we can hedge out risk while still profiting and participating in those moves. And that's what we time into these markets. And by doing so, we are constantly looking to be safe and participate and understand the market is constantly moving. It's always in flux. So as we watch that, we compare the strong versus the weakest. In the business world, the rear view mirror is always clearer than the windshield. So we do look back to history, correlations, and help us determine where those are at. But this was built years ago. I introduced it in 2023 as a long-term way to manage a long-term portfolio. And that's what we're doing with these X flips. So as we're watching this, couple of the, applying those currents, sailing on the current even, we can see that we saw down 8%, up 14%, down 23% as those moves on those crosses. We're participating in those crosses. Even on the way down, we can participate in an 8% drop and profit from the 8% drop, not just avoid the risk of the 8% drop. We can profit from those. As we're looking at this, the NASDAQ fell 38% in 2022, only to recover and run up 50% in 2023 and another 40% in 2024. A lot of times we don't talk about the fact that 2022 saw a 38% correction. People still want to say we're the biggest bull market ever in history. No, we're not. We dropped 38% in 2022. That's not, we broke the bull market. We broke the bull market in 2013. We broke the bull market in 2020. We broke the bull market in 2022. And so all those currents shifted and gave us plenty of time to watch. Now, it dropped 38% from high to low. I was looking specifically at when we knew that we needed to go short. And that's what we're looking at. Same thing over here as we're looking at this, the dollar index. The dollar index gained 22%, equivalent to 55% movement in indexes. The dollar has about a 2.5 times ratio in those index. So those of you that were with Garrett and I this morning, this is what I was talking about. The dollar gains and loses and usually see an inverse move in equities of 2.5 times for the indexes and 5 times for individual stocks. So in 2022, it also gave back 13% but in 2023. So we're watching these swings and gains and opportunities to get that 2.5 to 1 leverage in the indexes and 5 times in individual stocks. As we're looking at this, gold fell 22% in 2022, same time we saw the NASDAQ fall. And there's a high correlation between commodities and equities, like I already showed you on that other grid. As we're watching these correlations, gold recovered and gained 42% and 55% to the peak. And I put so far because the pullback I didn't expect to see today. So we'll see where that's going to pull. I'd say that's a reset from the pullback. We'll see if we can go to the high again. But I don't think we're done because the current's not done. We still have opportunity to get into those trades if we time it after we know the asset classes are moving in the direction we are. TLT or bonds gained 10%, dropped 9%. Even the surprise drop again gained 5% before falling. We're able to pick up that in that trend, in that current. If we pick up that current, and can pick up 5% right before then and protect it, we can participate in those moves. Even when the shock and awe, we gained, we walked away, we stepped away and waited for the pullback to find its base. Now we're looking to get back in on timing. Again, current number one, $500 billion moved into bonds in that week. Well, we'll call it 2 weeks. It's about 2 weeks time because I'm going to include that draw. So $500 billion, even after that correction, moved back in. We had almost $1 trillion move into bonds, pulled back, and another 500 billion move back in. That's why we're back to where we were and are breaking through the highs. When we talked about the dollar again, that dollar is pulled all the way back. I already showed you that chart on the quad. That spike up there has already sold back off. This is the euro versus the US dollar. So this is dollar weakness and euro strength. So we can trade into the euro while the dollar is weakening. Now the dollar is recovered and pulled back into this area. That's an opportunity for us. If the dollar weakens again, we'll see money move higher. As I commented this morning, I'm seeing signs when equities and the dollar and bonds move up all in the same day, and especially when they pull up an entire week, that means inflow of capital from overseas. It's a matter of paying attention to those currents. In bullish markets, the deep currents methodology wins. In bullish equity years, just buying equities, even the tech-heavy NASDAQ, you would net it out 23% over 2.5 years or 9% per year on average, which is a great return. It's outperforming the super long 100-year average. But by selling the weak and buying the strength, by using what you're selling to get into long positions and trading both, the strong up, the weak down, that same deep currents time frame would have made 35% per year, not 23% over 2.5 years, but 34% over the same time period per year, and ended up being over 70% during that time frame. In the bullish markets, we win. In the bearish markets, we're safe and we win. But here's the secret. The big secret here is you really don't need to be perfect about this. You just have to be following the best and strongest current, and we'll time it a little bit better. That's what we're doing. It's easier to reach your retirement goals by reducing portfolio volatility. You can make about 12% a year with a 2% drawdown every other year and still outperform the market that does 20% a year. So even if you say, well, I'm not making 20%, the NASDAQ made 23% this year. If you make 12% and don't have a drawdown at all, or up to 2% drawdown, you outperform. As we look at the pullback and don't experience that 50 to 60% pullback, this one, as we already said, is almost 30%. I asked the question earlier, how much do you have to make as a percentage to get back from a 30% drawdown? If you see a 30% drawdown, you don't make 30% to get back. That's not how you recover. As you're looking at this, when we're looking at the numbers, if you're trying to get to that move, you've got to do what? What do you have to do? You have to actually make 43% to recover a 30% drop, because it's 43% of the new balance. If you lose half your account, you have to double your account. If you don't lose anything, it's not a matter of doubling your account. Even if you were performing better than the market conditions, you'd have to make 12% a year for, we'll include some compounding, for 8 years just to get to break even. If we're making 10% or 8% while everybody else is trying to get back to break even, we keep moving further and further ahead. And there's just no potential of being able to sustain that type of recovery if you're not paying attention and managing it and have a plan. In 2007 through 2009, this method would have been long gold and commodities and short equities in the dollar. Not only would you have not experienced a 67% drawdown, you'd have actually gained 22% a year during those 2 years by just paying attention to those currents, because money didn't disappear. It left equities and went into gold and commodities. So here's the thing. Now, I've asked this question before. Instead of taking 7 years to break even, you would have no drawdown, participated also in the strongest bull run in history by following the currents. But do you remember when you were told how much it would take to retire? What number was thrown around there? How much were you told whether you're in your 20s or 30s or 40s, how much were you told to have in your retirement account by the time you retire at 65? Any numbers? Any numbers come to mind? Most were told you've got to have $1 million. Is that work now? How has house pricing changed? What about debt? What about medical expenses? What about your general peace of mind? Do you want to travel? Do you want to be able to give gifts to your kids, your grandkids? Do you want to leave something for inheritance? It's not $1 million anymore. The absolute minimum that CNBC this last week said is now 1.26 million as a minimum to survive. We're not talking about thriving. You're supposed to have 1.26 million there now. And
That's
that's,
wild because I don't even see that being like, realistic. It's just wild when you say it because it just doesn't seem like that's enough.
no, it's not.
Not even
That's like I
close.
said,
Yeah.
that's just to
Yeah.
survive. Yeah, and I hope you don't need a long care facility. Those are $10,000 to $20,000 a month. And so it's changed. I mean, $1 million. I was told that in my 20s. Like, if you just do this, you'll have $1 million. You'll be fine forever. Nope, not at all. And so that's the thing. And if you don't understand that secret, if you don't understand that plan, are you going to be ready for retirement? Are you ready now? Do you have a plan at all? How have you managed this last 3 months, 4 months? I knew that we're coming into recession territory. GDP is confirming that. How did you manage it? Here's the thing. Alexander Elder is a psychologist that turned trader and loves to interview traders and the best traders. He said beginners focus on analysis, but professionals operate in a three-dimensional space. They're aware of trading psychology, their own feelings, and the mass psychology of the market. And right now, how's the psychology of the market doing? How are people feeling? How are people adjusting to that? It's a little bit nutty, isn't it? Did they know what they're doing? I think you've seen it with Don's talked about the liquidity issues that we were seeing. Even the mass psychology of the market, they don't know what to do. They're reacting to noise. And that's going to hurt them. And it is hurting them. They've estimated trillions of dollars have now left institutional funds and accounts. And here's the thing for you, forget that. Whatever it's happening to them, that's their problem. The four biggest threats to retirement are: one, outliving your income; two, medical expenses, which can certainly shorten how that your income is going to be able to even get close to your retirement or you're outliving it; red ink in your retirement account; and inflation. In 2008, 2009, the number one thing that we were hearing, and I remember watching shows on 60 Minutes and CNBC and interviewing retirees, people that were already retired. And unfortunately, there's so much red ink in their retirement because they couldn't protect, didn't know how to, that they were saying, yeah, I'm actually applying at Walmart. I think Walmart is a fine job, but whatever you're going to do, you do whatever it needs to take to certainly do what things you need. But I don't think most people planned on retiring and then getting out of retirement to go be a greeter at Walmart. That's unfortunate when those corrections happen, that red ink that hits your account and you don't have time to recover. Inflation is still a key. It's still there. And again, if you don't have an adaptive, personalized plan to retire comfortably, are you ready? Where are the currents shifting? I'm going to show you a couple things with volatility. I'm going to go through this a little bit quick. I don't need to take a ton of time on this. We've been talking a lot about the VIX. In 2008, we saw the largest spike in the VIX since 2008, and we saw that spike up here. But just to give you an idea, historically, what we saw then and what we're seeing now, we saw equities, SPX, correct down here. And where did money move? When we saw this spike through here, and we saw the S&P 500, this S&P 500 versus the VIX, so you can see it, how they went counter. What did you do in that time frame? In that 3 weeks around the VIX, that spike in equities, that we saw equities fall 9.7% and individual stocks fall by more than 25%. Our portfolio outperformed during that volatility. This is a shorter time frame, so you can see the ebbs and flows, even with the spikes and drops of the closed positions. Mine are the closed positions there. As we're looking at this, we saw that again. As we're looking into this year, this is April. This is just a couple of weeks ago. As we saw that VIX spike again in the 4 weeks around that, equities fell 23.4%. Some individual stock were cut in half or more. And our portfolio outperformed during all that volatility. And the currents are still shifting. That's why you have to get ready now. You can't do this before or after. I do need to say this, Don. I don't know if you know this. Our performance from when I talked with Garrett just 2 weeks ago, we went from 2.3% to 4. And I pulled it up today, and our current is 4.3%. It was 92%. We paid for the entire program, as what we're looking at. We've profited through here.
Right.
It's
exactly what we're going to discuss right now is how you can be part of the deep currents breakthrough. With that, introducing deep current alerts, obviously by none other than Blake Young. So deep current advantage. It's 1997. This is actually going to include everything, obviously, that Blake Young is describing right now, but this goes beyond just instruction. This goes beyond the fact that we're going to be discussing here momentarily a mastermind, 12-week mastermind that comes with this to fully understand not only what these currents happen to be, but how you can, leverage this. But also obviously includes the portfolio, what Blake is literally trading. As he was mentioning moments ago, and I'm going to show you here in just a moment, literally just from 2 weeks ago, how significant some of these currents have been, and that those changes literally in the last 2 weeks would have paid for the $2,000 that you're investing, not just in your education, but really the $2,000 that you're investing in your retirement. So let me go through everything that's included here with deep currents, answer a couple of questions here, make sure everybody's kind of on the same page. So to begin with, obviously, we've got deep current and alerts. But before we even get to those alerts, deep currents is going to kick off a mastermind. It is going to be a full 12 weeks with none other than Blake. Extraordinarily detailed. And I'll get into more specifics of this, but it kicks off May 7th, which is, again, it's right around the corner. It's 3 p.m. Eastern time. Every single one of those is recorded. There's a lot more than just, 12 weeks of Blake ultimately talking at you, but this is where there's portfolio evaluation, where you can actually kind of, almost sit down with Blake and look through specific positions. Even if you have a registered investment advisor right now, okay, going through this just to learn, okay, the proper questions to ask that registered investment advisor is more than worth the $2,000, because people don't have no idea where their money really is effectively right now. And more appropriately, they don't even know the questions to ask some of their advisors. With that, though, we believe that this is far beyond, what any of those advisors would ever be able to instruct you to ultimately do with your capital. So there's a 12-week mastermind methodology, okay, that you can use to beat the market, okay, throughout your life. Now, the next aspect of this, there's $100,000 beat the market portfolio. I just want to throw this out right now because everybody was asking me, it's a $100,000 portfolio. You don't have to have $100,000. In fact, Blake is actually going to show throughout the course of the mastermind various ways and alternatives, if you will, okay, to take positions without tying up tremendous amounts of capital. That is an important kind of concept I want to hit on right now, too, because first of all, yes, everything that we're doing here can be done inside of an IRA. That's always a question that comes up. But the $100,000 portfolio, it is not essential per se that you have the $100,000 in your portfolio. Now, the big one in here is weekly deep current alerts, which is a $2,400 value unto itself. This is literally, okay, the moves that Blake's making, okay, with his own capital. Obviously, that's the $100,000 portfolio that we're effectively tracking. And that's why when we mentioned, just in the last 2 weeks, you'd have pulled out $2,000. That's based specifically from this $100,000 portfolio. Then we have the deep currents coaching calls, which is 12 months, okay, of new and updated positions. So not only is he going to go through 12 weeks of a mastermind, but after you've gone through the mastermind and after you're starting to kind of get enveloped inside of deep currents and you've got a couple of positions on, then he's actually taking you through monthly coaching calls. And these coaching calls are kind of detailing why we've actually made some of these moves, refreshing your mind, okay, on, literally the structure and the meaning, if you will, of some of the positions that you're effectively in at that moment in time. And moreover, what Blake kind of sees as some of the new currents that are forming at that point. All right. Then we actually get into the deep currents watch list. Okay. That's simply what is Blake looking at on a day to day basis. Can't describe it any more cleanly than that. And of course, full email support. And this is where you can get in with one-to-one conversations specifically with Blake, although he'll even communicate with you directly inside of a chat room. If there's something that you would like to actually discuss privately, email us. Now, I always stress that emails. Okay. All of this has a 30-day money back guarantee. So I'm always so adamant, and I always mention the 30-day money back guarantee. Look, we get it. Sometimes life gets in the way. Things kind of come up. Okay. I think everybody's absolutely going to love what Blake's actually doing. This is a very different genre, if you will, of trade than anything we've been involved in before here at Theo Trade. We're all pretty excited about it because the portfolio effectively speaks for itself. Look, in the 30-day money back guarantee, the stipulations, there are none, right? There are none. Like, so there's no excuses, no questions. You just email us and you get your money back. And I do want to take you guys over to the site really quick as I pull this up. It's theotrade.com/DC. That's D as in Don, C as in Charlie. Theotrade.com/DC. I also, this is the first time I'll actually put this up here and remind each and every one of you, if you're not comfortable, okay, and you want to ask a couple of questions, hit us on the phone, 623-244-5657. We'll actually pop the number directly into the chat room. Again, 623-244-5657. As you scroll down, okay, under the enrollment, a couple of things in here. Email address. Don't use like the hidden email address that you would like off of Apple. You want to put a valid email address because when the alerts are coming out, we contact you in a number of ways. We use email, we use push notification, okay, and we use text message. And the reason that we use all three of them, we've got people spread all over the world. Somebody was actually just mentioning, well, from Iceland, but in Spain right now, probably not going to receive a US text message, but you will absolutely receive, okay, email, and you'll receive the push notification, regardless of really what device you're on. So give us a valid email address. In addition to it, give us a valid phone number. Because if you are inside of the United States, fantastic. We will get you your text message. Just depends, again, where you are. Also, in terms of payments, yeah, there's a payment plan. It's right on here. People constantly ask that. And of course, all of this, okay, is applicable to the 30-day money back guarantee. Now, Blake was actually mentioning a moment ago that himself and Garrett were actually on and talking a little bit about deep currents 2 weeks ago. And had you had actually joined literally 2 weeks ago and followed this, everyone who joined and acted on deep current trade alerts, okay, already recovered 92% of their enrollment investment. Your investment being $2,000. Effectively, okay, you're up what? About, just shy of $1,900 on that. That's literally the last 2 weeks. And I love to kind of illuminate this as I kind of go through, because again, over here, if you're kind of curious, yeah, that's the S&P 500. This is Blake. And that's such a critical thing because again, we're not talking about some short-term trades. We're talking about your retirement portfolio. And that's why I said it's a really unique kind of genre, and something that just because I'm an active trader doesn't mean like I don't have an investment portfolio. Of course I do. Okay. And when you look at this, it's all about growth over time. That's what your investment portfolio should be, is growth over time. And again, don't worry about the fact that you have to have this $100,000 account. That's something that Blake will specifically detail inside of the mastermind. In fact, I'm going to go into a lot more detail, well, right now. So the Deep Currents Mastermind. So this is a 12-week mastermind. And as I said, it kicks off on May 7th. Now, not only is he doing 12 weeks, because that's not enough, Then we're going to actually have an 8 hour session. By the way, I just saw this because he just added the 8 hour session. He's like, sometimes I feel like I just haven't gotten everything done in 12 weeks and I want to kind of reiterate everything. Okay. This is what we call Blake torturing himself. Okay. I'm going to tell everybody right now, just a 12-week mastermind. Okay. Plus an 8 hour Saturday session is worth well more than like 2 grand. I mean, you're getting so much time. By the way, every item in here is going to be recorded. So it's again, there's going to be in class and it's applicable that particular day. He's actually going to trade a little bit. He's going to give you some setups during the course of the mastermind. Obviously on Saturday, that's a lot of recap. That's a lot of answering future questions that are going to be coming up over here. But there's an entire special room just like the room that you guys are in right now. But there's a room dedicated expressly to deep currents where you can not only talk to other clientele, but you can also talk directly to Blake, ask questions. That's where your trade alerts are going to come to. The guys that get intimately familiar with that. But again, you basically get it's about totaled up 25 plus hours, okay, of Blake and instruction. Now, I
That's
know
not
that
true. I can't keep to an hour done. It's actually over. I timed last time is 33 hours.
oh, is that so? I was being
You're shooting.
conservative. So yeah, like usually where you see the 12-week sessions, like look, I know that there's a time investment over here. I don't want to freak anybody out with that either. Because I always say this, like there are people that, you know, I don't care. They just want the alerts. I'm down with that. Okay. But I'm the person, like, I have to know how the sausage is made. Like, I have to know how that sausage is made. And I mean that, like, I would listen to all of this. Now, for those of you that have time constraints, may I make a suggestion to you on this? Because if it looks like a lot of time, you're like, ah, crap. Okay. Let the session go by, play it back, okay, at time and a half. We have that capability. We have the technology. Play it back at time and a half. Meaning, like, Lake sounds like a chipmunk, but he pretty much sounds like a chipmunk anyway. It's good. I want to try to save you guys to be efficient with your time, but I would actually listen to it. Next, okay, this is the Beat the Market portfolio. We provide trade alerts during class, okay, during the week by email, posting the alerts in the deep currents room. All the trades are managed, beginning to end, opening, close, any position changes over there. You do not need $100,000. That's only like the fifth time that I've said that in your account. We put the $100,000 in the account because it's a nice baseline. We have people that are going to do this and are doing it right now, okay, with $3 to $5 million. We have people doing this, okay, with a few $1,000s in the account. And again, we have kind of like substitute trades. Well, I can't do the trade in gold because I don't have enough money to buy gold. Okay, so we can actually substitute that specifically with an options trade. And like I'll discuss that, of course, during the mastermind. Okay, we provide trades for smaller accounts if that is applicable to you. Now, this also includes, of course, IRAs. So don't worry about it. Your retirement account, okay, is included in here. Okay, weekly deep current alerts. Okay, what we alert. Okay, are you right now? Do you feel you're at one alert per week, or are you actually
Oh
more than
no,
that?
we're a lot higher.
Okay.
So yeah, if we take out the alternative trades and kind of say position kind of the strategy that way, we're at about 3 a week right now for this year.
Yeah, I always like to kind of give a baseline. And
Yeah.
when we look at this, as you said, it's been averaging 3 to 5 alerts a week. But uh, when you guys start looking at this, like over the course, it's it's a lot of alerts. It's a lot of alerts, and like if you look at 3 alerts a week, you're like, it's a lot of alerts. A lot of it is updating on positions. Okay, closing this, opening this. I don't want you guys to feel like you have to sit in front of your phone or in front of your screen the entire time because that's it could not be further from the truth. The next in the docket over here, okay, these are the coaching calls. The coaching calls usually last about 80 to 90 minutes, and it's just like once a month. Okay, it's just kind of continued mentorship, why the positions are on, okay, what he's actually effectively doing with it. That's again what we are, about is not just discussing some of the positions in good, bad, or indifferent, but really where we're actually headed with these portfolios. I put a lot of weight into the coaching calls because they provide clarity on kind of where we are. You kind of, you have a couple of alerts come out and you're like, So wait, where are we right now? And this, okay, just kind of snaps you back to the reality of like, all right, this is the rotation we've had to make at this point. Okay, here's exactly why we're doing it, and this is where we're going with it. And I think that they're really insightful. In fact, if anything, what I've actually tuned into deep currents since we've actually kicked this off is specifically these coaching calls because I actually find these the most insightful. Sorry, Blake, the
You're
12-week mastermind. I've caught little pieces of the 12-week mastermind, but we've worked together for like 20 years. But I actually do find the coaching calls because the coaching calls is where he's actually talking about the future, if you will, of where we're headed. And it's not like crystal ball stuff. It's literally like, okay, currency is doing X, Y, and Z. Look at the commodities right now. Look at the bond market. Okay, here we go. And kind of almost like a game plan, strategic game plan to where we're headed for the next month. All right, onward from there. The deep current watch list. Do you really have 100 instruments in your watch list? Are you less than that right
It's
now? Because
gotten
I,
bigger
yeah,
and smaller. It's got expanded and contracted. So it's really more I give you a scan, and that's why it's updated with time. And so we'll show you how what I look at and why we look at them. But yeah,
yeah,
it's gone to 110. It's gone down to 60 some, but
I find myself looking at a narrow scope of products in
yep,
this volatility because there's so much noise right now. And I was curious about that one because you and I had not necessarily conversed, in that regard for some, considerable period of time. So
right.
again, there's a watch list. You'll get Blake's watch list. Whether there's 100 instruments on it, that's going to expand and contract over time, for sure. But
It is
the
definitely
watch list,
contracted recently. So
yeah, it's funny because for like years, I thought, oh, it's the same watch list here, but even my watch list like recently has changed to some extent, to some degree. So let me recap everything in here. Okay. Um, Obviously, you've got the methodology, got the portfolio, you've got deep current alerts themselves. Okay. The deep current coaching calls. Okay. The entire and again, I can't express this enough. You're going through a 12-week mastermind, and those masterminds are huge. And when I say they're huge in terms of the insight that you're actually getting in the education, you're going to get over 30 hours, it sounds like, of Blake. I was estimating somewhere around 25, but you're going to get approximately 30 hours plus of Blake. And it really is and feels like a one-on-one session. And that's actually, we're going to turn the corner and actually hit that on May 7th. Obviously, his watch list, email support is also included in here. That's other thing I want to stop and pause for a second on that one. When I talk about like the email support, that's one that like really it can't be overstated how important it is for you as a client here at TheoTrade to be able to reach out to us at any point in time. So you're a client of TheoTrade, email us and email us trades, trade ideas, what you're thinking. Okay. Even if you disagree with something once in a while, it's okay. You want insight because if you disagree, why put a position on you disagree? That's okay. Like have some back and forth over there. When you email us, though, you can talk about trades. Like there's just no other place in this business right now that you can do that. Like I emphasize this again and again because I've realized it. Like you don't call up like, and I always mention this, Blake. There was that famous slogan, talk to
mhm.
Chuck. Okay, Chuck, which is Charles Schwab. It was always this commercial on like, talk to Chuck, call Chuck. I got to tell you right now, Chuck ain't answering the phone, and if they do, it's some 20-year-old kid. I'm not poking at anybody younger. They're intentionally putting brokers on the phone, okay, that can't and won't answer specific trade related questions because the regulatory side of this business, I mean, if you ask Blake, myself, Brandon Chapman, and Jeff Bierman, okay, the overwhelming reason that we left the brokerage side of the world, okay, is regulatory. It's absolutely horrible. You can't say anything. You don't want to say anything. And if you do say something, okay, you're liable. Here,
You
we're
literally
giving you
can't
the
help
emails.
them without being liable. Yeah.
Yeah, no, and you know what? I'm fine with that. Okay. I would rather have some liability and
Yep.
somebody just be left to like their own devices. Ask us the damn question. I don't care. Okay. Like, look, I've had every brokerage license imaginable. And I know how to answer the proper questions. Like, it's not fair for you to say, you think Apple's going up or down? I'm like, come on, it's coming out in an hour, man. I don't feel for that. Okay. By the way, going down. No, I'm just kidding. So I took the trade, it's going down. But the point I'm trying to make, like if you have a real like question in here, you're nervous about the markets, I'll tell you how to position yourself. Blake will tell you how to position yourself. But with like deep currents, again, the reason I'm so adamant about this is like, holy crap, you pay $2,000, you get to email them for like, this extended period of time. It's your retirement portfolio. I'm going to tell you right now, there's going to be somebody in here that has $250,000 in the retirement portfolio that won't take the 30 hours to even listen to it. Okay. You should just get out of the market. And I hate to say that, but I get angry about it because if you're not willing to take some time right now, okay, what has been classical representation of finance has changed. It's changed. There's a deep current private room. Now, the private room over here is just a room just like you guys are in right now. And it's literally the room that you're in like right now. And we just converted into a deep currents room. And you get to actually have back and forth with clientele. When Blake actually broadcasts, that's the place. It's one stop for everything in there. Okay. And again, gives you the that on-demand access to it. Okay. And that's also it's critically important to you. Okay. So I I stress to you guys again, you've got access to the room. The methodology in here you can use to beat the market, okay, in all conditions, priceless. Some of this, and again, is what will change over time. And Blake, that's why he's doing those monthly calls. All right, 30-day money back guarantee. Now, this is the incentive for you to enroll now. There's 100 spots in the 30-day money back guarantee. We do that ultimately to incentivize you to enroll today. Not to mention that you're only a few days away from that May 7th date. So get in now. It's 1995. And again, there's unlimited email mentoring. There's a 30-day money back guarantee. There's no risk to you. Get in there, check out the mentorship. Make sure it's for you. As I said to you, one of the reasons we do the money back guarantee, I get it. Sometimes life gets in the way. Now, as I said a moment ago, we're here to help. If you ever need us, if you ever need us, okay, you can email us or you can call us. And I'm going to leave that number up there for just a second. 623-244-5657. Again, 623-244-5657. Your questions answered. Okay. What do you need? Oh, you want to go through some of this a little bit, Blake, with me?
Sure. Yeah.
What do you really need to get started?
You need to be able to wiggle one finger, um, have a computer and internet. That's about it. It could be a tablet, really. Like you said, you don't even need a laptop anymore. It could be a tablet, could be your phone. You could theoretically do it any digital device that has internet connection. And like you talked about, we have people trading multi-million dollar accounts in this portfolio. We have people that are trading $3,000 to $5,000 accounts because we give trades that work on all of those. So anytime I set up any type of trade, you just have to be able to follow the instructions. And we're really clear. And someone asked about an alert methodology, and we'd say, you buy this to open, and this is the thing for this time. And we tell you where to get in, we tell you where to get out, we tell you any adjustments. So you need a internet connection with a digital device, you need a cell phone and a way to track the text messages and emails.
My phone.
And that's it. I mean,
My
that's
phone.
really, you have everything.
Yeah, you know what? That's like, by the way, for those of you looking for an excuse to buy like an iPad Pro, you can use this as an excuse to buy an iPad Pro. It's really funny because somebody shot me an email the other day, Blake, and was like, "Do I need to buy like a special iPad for this?" And I'm like, "No, I use the $300 like Walmart iPad. I'm dead serious. Like I literally use a $300 like Walmart iPad." And he goes, "Well, can I at least tell my wife that I'm a lie and that I need like an iPad Pro?" And I go, "You go for it, man. I got your back. I got your back." Okay, we're in deep now. We're in deep on this one because I'm waiting for this email from his wife. Like, it's coming. Okay, did my husband really need an iPad Pro? The answer is absolutely not. I'm going to throw him right under the bus. Absolutely not. I use a $300 iPad. It absolutely kills me. So it's a yearly membership cost for the deep currents. Again, he's providing about 2 trades a week, 2, 3 trades a week. It's a little active right now. If you haven't looked around,
It
crap's
is.
crazy right now. We're going to
Well,
provide you
and
access to 3 trade mobile. Go ahead.
I was just going to say, and don't forget, signing up today, you'll get all the alerts between now and class starting. So don't think that you can look at the alerts and determine whether you want to take the trades pre-class. But we'll tell you the methodology when class starts and the mastermind starts. But I expect that we're going to have a couple of trades before next Wednesday. So just be aware. The alerts will come through whether you've gone through class one or the mastermind, the alerts, you will get those alerts. And I expect multiple before next Wednesday.
By the way, that I'll remind you guys, add your cell phone number when receiving it. Like, so, I'll throw this up here one more time, but make sure the email and the phone number are valid. If they're not, like, look, we can change them later. I just, that's one thing. Like, people are like, I have not gotten any alerts, and they've been in there for like a week and they're freaking out. And I'm like, did you have the number right? They're like, I don't know. We'll make sure it's right. Look, next thing on here, you can email us anytime, receive a response within 24 hours. Okay, we've mentioned that to death, and that's important to us. Look, variations of the trade are available inside your IRA. You can do this with an account as little as $2,000. Obviously, with $2,000, you do have some limitations. Blake is actually going to show you a number of alternative trading strategies specifically for smaller accounts. We can help you get approved because people always mention, like, I can't do that with my brokerage firm. I'm in Fidelity. It's not fair. Okay. Calm down. Okay. We can hook you up with a bunch of brokerage firms. So we're really familiar with the brokerage business. I spent 15 years in the brokerage world, and we know everybody, like from E-Trade to Tasty Trade to Charles Schwab to Robinhood. We have connections everywhere. So don't worry about that. Remember, there's 100 riskless trade spots are available. Get results, take action, enroll for Theo Trade now. There's no risk to you. It's theotrade.com/DC. Look, Blake and I are actually going to sit in the chat room. Blake's actually going to be in here answering questions one-to-one directly inside of the chat room. If you need us, again, do not hesitate to call us. That number, again, I'm going to throw it right to the top of the screen. It's 623-244-5657. I want to thank everybody for actually tuning in today. And more than anything, I actually want to thank Blake for going green. You totally should have
Thank you.
painted yourself. You should have painted
I
yourself green
should
for
have.
this. Should have put a green filter on. Would have been good. Thanks everybody for tuning in. Have a good one. Bye bye.